for joining us today, Ron.
Pleasure. Always an honor and a pleasure to support, but also now more than ever to actually be part of the master group live in person. It's good to meet with some of you and put a name to a face. I've been seeing the names on Slack, and it's good to actually meet virtually in person.
Yeah, for sure. Where are you today, Ron?
UK, home sweet home.
UK. All right.
Where I spend most of my time, but not all of my time. Previously in across different parts of the world, but most recently in the Middle East and Asia. So it's been interesting. Today I thought it would be thematic and timely to discuss one of the seasonality patterns, which is the Santa Claus Rally. And one of the most popular questions I get asked, and I'm sure other seasonality experts like Jake, for example, would have been asked many times, is with some of these seasonality patterns, is it a fact or fiction? And I think the ones that get asked the most on that point is the Santa Claus Rally, just because of the whole festivity correlation. But I will share some insights based upon different types of seasonality patterns that I've used, along with the framework as well. So let me just kick off. Quick disclaimer. Brief word on what we do on the foundation and how I'm happy to continue the work. So the backstory is that I've was introduced, like everyone, to Dewey's work through a recommendation. In my case, it was mentors in the early years, and it was actually the Cycles magazines that were actually given to me early on to read as part of the training. But then also I managed to get a trip included to see what was the previous FSC library in New York. Richard, you may, I'm sure already know of what used to be the MTA, now CMT library at the Birkbeck College. So in there, just before I caught my flight from New York back to London, managed to get a glimpse of some of the archives, Dewey's work, but also other cycle pioneers. And I think it's great that we now have a saved archive. So big credit to you, Richard, for making that possible. And I look forward to us being able to see that digitally and perhaps in person in future. Now, in down. It'll take time, I'm sure. And I look forward to it. Open question, can we still expect a Santa Claus rally in equity markets? So these are the key points that I'll run through. I've got a timer in the background just to make sure everything is paced in the allocated time. If I could just double check, Richard, how much time do we have for the rest of the session?
About 45 minutes.
Okay, so we have good time. I wasn't sure.
Yeah.
I was thinking
go about 90 minutes.
Okay.
You don't have to take it all.
Yeah, I'll be selective with the key points, and feel free, anyone, to fire away with questions, well, throughout, or if you want to hold back towards the end, I'm fine either way. Just as a heads up, there's educational resources that will be shared on our master working group Slack. So one has already been shared. That's the related media interview to this discussion on the Santa Claus Rally. And then the second is a bonus that will be published soon on the FSC cycle blog. So that's to come soon. Now, the three key areas to focus on: first is market landscape. I find it's really good just to start with the big picture. Market context. Often we look at things in isolation or linear terms, and I think being with cycle like-minded professionals, we know that context is so key, and it's really important to have a more dynamic sense of the landscape. So I'll run through one way that I do that, similar to Richard's approach, but probably a bit more old school and classic. It's a simple ranking model, looking at best and worst trends within a quintile scoring system. That's looking at cross asset. It's my radar screen that I look at on a regular basis. And you may have seen me share it in prior FSC events. That basically highlights a broad surge in risk proxies, which is clear as as day over the last few weeks. But the bigger question is what next into year end and the new year. That was led by US equities, the same growth story with mega cap stocks, but also this time was slightly different. There was a little bit more participation from year-to-date laggards as what I think is a growth value rotation. And just as a quick heads up, because I get this question a lot, and there's a polarized view out in the market as to what healthy rotation may lead to. I'm still in the bear camp for next year, still timing whether it'll be, first quarter, and then we pause, maybe go sideways, and then have a relief rally. Maybe it's a mixture of different scenarios, but the point is, a sector rotation from growth to value will still likely be bearish, because once, given the market cap influence, but also the extent of the rally, any unwind or consolidation will still likely add further asymmetric risk. So something to keep in mind in terms of past rotation and potential near-term risks of that move. And then this big talk about the best rally of 2023, partly expected after a 3-month drawdown. But again, the extent of the bear market rally, or could be a whole new rally, time will tell, was probably unexpected to most. That also followed the macro setup of the Fed Reserve and its silent pivot. More to the point, Santa Claus Rally. What is it? How does it occur? Seasonality. The insights I wanted to focus on is seasonality is not a one-size-fits-all. So big disclaimer: take care with all the work that we do, and try and look for variations. Instead of showing you what does work, I'm going to show you when this does not work. And I think that can be equally, if not more useful, particularly on the point that Richard made about behavioral biases. Once we anchor on a particular pattern, our expectations shoot up, and that can unravel all kinds of risks. Mm-hmm. And then finally, the punchline, S&P 500, what's the current setup, expectations? We'll look at my perspective on the latest price and time inflection point. The chart's already in Slack, so most of you would have already seen it. The underlying risks in terms of concentration risk, market fragility, and then something I found quite interesting recently in terms of what could be a big pain trade with the smartest minds in the financial institutions, and a wide divergent year-to-date forecast on the S&P 500, which I think is going to be interesting because someone's going to get it right and someone's going to get it wrong. And in between, there's a big gap. If I could just get a quick show in the chat of which part of these key points are of interest to each of you, something that I do with students and clients. So if you it's just my way of getting a pulse check and a sentiment read of what's top of your mind. Just refer to whatever you think is of most interest, and then I can maybe highlight it more as I get to that stage. Okay, so the framework, just briefly, thank you, Gary. Expectations there, I'm guessing, is the bottom line interest. The framework is a top-down framework, big picture, but big picture looking at a blend of macro, fundamental, technical. I always was trained and specialized in technical analysis, but one of my early mentors was more of a behavioral market expert, and so he just spoke about the ecosystem of markets and how it's an organic beast that we had to learn, understand, adapt, and ultimately the framework is a combination of multiple different factors. So that's why I say macro, fundamental, technicals, and the perception of each one of these factors. That includes a blend of quantitative and qualitative measures. I'm big on quant, but only when it's in the context of a qualitative framework. Otherwise, again, it can lead to misinterpretation and various biases. Then, of course, the Bill Lendl cycles, and there's a roadmap cycle framework developed by my mentor that I'll quickly speak about, predicated on a business cycle, but also seasonality patterns. And then last but not least, on the left there in green, trend ranking models. This is more the quant side of things, just a way of ranking and scoring different trends and risk opportunities, risk reward opportunities in the market. For anyone who's interested in learning more about my mentor's work, which I now use and expand on, the book is Mapping the Markets, published by The Economist. And the mentor that I allude to is Robin Griffiths, that some may have heard of. There's plenty of information about him on the web. Okay, so this is his roadmap cycle model, originally developed by himself, looking very similar to the Edit Wave model, but it's different, similar in terms of shape and the behavioral fractal approach, but different, of course, in terms of the labeling, but also in terms of the meaning. What it shows is that most typical cycles have an asymmetric shape, but on occasion, as we know, that there can be cycle translation, deviation, and so you're going to get different skews in the cycle. This is just the traditional one for now. You can see that the cycle is combined with an economic kind of traffic light overlay on the top, and that's part of the blend between macro and technical. And currently what it suggests is a late cycles setup, which we've been in for some time, and will likely reverse more clearly into the new year of 2024. Now, the economic cycles I allude to are ones that many FSC members will be aware of, because these are the well-documented, researched cycles. There are many more, but these are some of the key ones, originally based on the work of Austrian Harvard economist Joseph Schumpeter, who basically researched the work of other pioneers and put it into a cycle schema. That included the Kondratiev wave, which influences interest rates and social mood, also war cycles in terms of inflation, and what that does to society and wealth gap divide. Jugular cycle, which is more based on the long-term business cycle, the boom-bust cycle that we will allude to. It also correlates with sunspot cycles for those of you who are interested on the science side. And I know Ray Terms would be happy to hear me wave that flag in a market session. The kitchen cycle, which nowadays is more correlated to the presidential cycle, but prior to that, it was a British cycle, later on fixed from to the one that we know now. And that's naturally going to be important going into 2024, the election year. And then last but not least, seasonality, which you would have heard plenty about from Jake Bernstein, our FSC board member that specializes in this area and has a whole lot more experience and software power to actually produce the stats that are useful for that area. The bottom line is that, as with all cycles, especially the key ones, when they align, then you get this unique crisis opportunity, or the so-called tidal wave. And that's what each of these cycles have been showing in different ways. Naturally, because there are different types and different lengths, there are going to be leads and lags. The blended approach, this is more of a practical, hands-on visual, and it just shows how, think of it as a kind of a checklist approach, not necessarily sequential. Sometimes the rotation from each of these sections will skip or backflip according to the analog that we're in. But essentially, you're looking at economic stages of the cycle: early, mid, late recession, but through the lens of growth. And I'll just quickly use the annotation: growth, valuation, and technicals. So macro growth, fundamental valuation, and technicals, which I think we all use all three. And I see a lot of members using, alluding to each of these areas in the chat. So more of what you're already using, whatever indicators you decide to use in each of these sections are always going to be useful. And then the decision-making process in terms of portfolio or asset allocation, which assets, what style, or sectors from an equity perspective to focus on. What this all says right here and now, just to give an update read, late stage into recession marked by growth contractions. We're already seeing signs of a slowdown, followed by credit pressures on the macro side, and there's plenty other points that can be added. In terms of valuation, the growth value rotation that I think everyone's been aware of, and the concentration risk that is now as extreme as 2000 tech boom crash, and hence the asymmetric risk that it carries. That will likely rotate into more value, cheap stocks, which could be potential buys into the new year. But as I mentioned before, even if we get that rotation, the risks will still be to the downside given the influence of market cap growth stocks and the extent of the rally. And in
So
terms
Ron, the red dashed box is the current conditions in your opinion?
Good question. So
And
yeah, thank you
the
for
asset
asking.
allocation is that's sort of your, the optimal asset allocation for this kind of market.
Yeah, important question and difficult, or maybe kind of a more fluid answer that I'll give. We're shifting from late to recession, and we've been doing that for some time. According to my work and the work of my mentor Robin, the recessionary indicators according to each of these factors were delayed. Some of them recovered marginally, but then eventually we went back on track. The beat reappeared, and we carried on forward. So right now, for example, to be more clear in terms of macro growth, it's falling post peak. This is US centric, so we have to be specific to the markets. But what that has suggested for some time is that cash, from a portfolio perspective, is the most prudent position. But cash, for the additional reason that we had 5% yield, so people paid handsomely to remain in that position. But also quality bonds where that made sense. Large cap growth more from safety. This is probably where we're still transitioning, and will likely go into high quality, low volatility. So that point that was made, it was someone in our group mentioned about volatility being good or bad. I would preface it, in my experience, it depends on what stage of the cycle we're in.
I think Stan's point was about if you're trading, you like volatility.
Oh, sure. Traders that can handle it, yes, absolutely.
That was my point.
Yeah.
Okay, and I'd agree. I think it's case specific to the temperament and the strategy of the trader or the investor, but I would also add the stage of the cycle. And that's been some work that I've tested in the past in terms of how factors change. I mean, we can just think of volatility as a factor. Momentum is another factor, and there are many others. And there's a lot of institutions out there that test how these factors perform at different stages of the cycle. The only issue is they tend to use economic data, not market data, and very few use cycle data, which is, I think, the opportunity that we have at the FSC. Where it is probably a little bit more opaque, just to complete the guidance to the question, which is I'm guessing is on most people's mind, is safe haven. What is a safe haven nowadays? And so that's chopped and changed, but I think gold still remains as safe as it gets. And the two things I want to highlight about gold, although I'm not talking about gold today, is that how did gold behave? Forget what gold did for the last year or two, which is pretty much nothing. And for that reason, it became unloved pretty quickly. Look at the two crisis events of this year that we're about to close. March, banking panic, gold shot up within a day and a week. And then, of course, the geopolitical risks of the war now between Israel and Hamas, same thing, gold and actually Bitcoin shot up. So there's an ongoing debate as to whether gold still holds its shine, and I would say in price terms it is, because it's retesting that $2,000 ceiling. In other currencies, it's at all-time highs as part of the debasement case, which is happening. The cash in our pocket is losing its value day by day. So we have to think about alternative tangible assets. But last but not least, gold actually spikes and surges during crisis events, whether it be inflation or geopolitical or other. And then it's really interesting to go back into history and identify some of the analogs. And then just to end on this slide, the ongoing recommendation, in my mind, is just to be flexible. I mean, whenever I decide on a binary trade, I'm often crowded out or maybe proven right or wrong. And as we all know, it's never about that. It's about staying alive and and staying on point with our strategies. So my preferred recommendation has been a barbell strategy, where you're still trading the stuff that's going up if you're a trend follower and you have that long bias in the sense of risk assets. But at times where there's a transition, you can be selective, take profits. And a lot of students and clients I speak to have issues with taking profits, especially now. FOMO is real after this year's first half, particularly in tech and other areas. And then previously, in previous cycles, bonds were a safe area, but open question as to where that would be now. And then lastly, to circle back to the discussion point Richard led on, non-correlated portfolio risk. For most institutions and private investors, that makes a lot of sense, particularly when truly all the eggs are one basket. And if that is in danger, then of course it's a much harder profile to manage. Okay, onto market landscape and the global ranking model. As I mentioned, it's classic old school trend following model. The only thing that makes it unique is that it has a scoring and ranking method, and it does that across different cycle measures. So strategic long-term, tactical medium-term, active short-term. I use this as my radar screen on a regular basis, and we'll run this on different markets in terms of cross-asset, market-specific, sectors, stocks, currencies. The data is up to you, but essentially, this is one of the go-to screens that I'll look at just to see how the trends are changing. Now, obviously, if you get all three trends pointing in one direction, up or down, then that's giving you a consistent trend signal. But then when you get divergences, that gives you potential rotation or an unwind that's taking place. What it shows right now is there was a broad tactical surge in risk proxies, world equities, Bitcoin, gold. The last two markets I just mentioned behaved a little bit more as also were supported by geopolitical premium in the market. So there's a little bit of a hybrid behavior there on those markets. But generally speaking, it was the risk on surge. You can see that it's not all about the USA markets. It was actually Germany. And if Lars was here, I'm sure he'd support this highlight. Look at the DAX market. It's a very different structure, and I would say a little bit more of a stronger, maybe more of a bull trend. But Germany's been leading. That's a little bit part of the Europe value trade versus the US growth trend. But nevertheless, USA is there. You can see in blue as part of that biggest rally we've seen in a long time. And you've also got emerging markets like India at all-time highs, Japan, which has been the best market globally, outperforming the S&P 500 in the first half of this year with better valuations than US markets. And it became the market that most people chose over and above China when that reopening trade failed to work earlier this year. I just came back from Asia, and I can tell you a lot of people are invested in Japan. And this year in particular, there's lots of Western foreign inflows into Japan. Warren Buffett flew there himself and announced Berkshire Hathaway was going to buy into some of the top banks. From the macro perspective, what's interesting is not what's top, but what's bottom. And you can see in pink, interest rates. And that just shows the unwind that we've seen from the 5% historical threshold after the Fed's so-called silent pivot. They haven't cut yet, but they were less hawkish, and ultimately they didn't raise rates. There's a whole lot of talk now in the market of the next cut and how much will it be, and that seems to be the new focus. Now, in terms of the extent of the rally, I find it so interesting to tune into news channels and read, the various kind of sentiment trends, whether it be Twitter X or just, with our industry peers, when everyone gets, at these behavioral extremes, whether it be bullish or bearish. And clearly this rally has created a big kind of shakeup in terms of how fast and how much it moved. So historically, it is the best rally of 2023 in both cross-asset relative performance, which is this top chart here. This is my way of quantifying the relative trend cross-asset, but also absolute terms. You can see this chart developed by Bloomberg showing that it was the biggest 1 month rally and 1 month rally of November for the year, but also only comparable to 2022 Q4. I find that also interesting, not just because we're breaking records, but because it also begs the question from an analog perspective, what happened after 2020? What happens after these moves? Do we carry on higher or do we unwind? This is a question I was just asked recently by several people. What happens if markets continue higher? The Wall Street mantra is markets can remain irrational longer than we can stay sane or solvent. But my question to all of you is, how does this change the asymmetric risk? For those of you that still believe the market has big downside risk, if we go higher, what does that do to your base case? What does that do to the market? I'll maybe save that response to the end, but it'd be great to share your perspective on that. Santa Claus Rally. I'm hoping some of you are Frank Sinatra fans. I was going through some of the Christmas classics. Thank you there. Ian gave me the thumbs up. Richard?
Oh, yeah.
There we go. Wonderful. And perhaps others. So the one that chimed most, A, because it's Frank Sinatra and he has a beautiful voice, but B, because it aligned with the theme, is the line, Santa Claus is coming to town. So the question is, will that happen or not this year? In particular, because many benchmark equities have already scored their best month in November, as I just mentioned. And so it's an open question for this new month of December 2023. Now, in the evidence and the stats is that the Santa Claus Rally typically leads to a plus 1.3% gain on major market indices. It depends how you measure this, especially in terms of historical sample data, but also what dates you choose for December. Believe it or not, according to my work, and maybe some people might agree, the Santa Claus Rally doesn't just end in December. It actually takes you into early January. So you need to change that time window on your spreadsheet when you're testing this. Most people just do the month of December because most software just defaults on that, but you can change that on a spreadsheet or any custom program that you use. The other thing is to keep in mind that the Santa Claus Rally is the back end of December. So although we're talking on December the 4th now, it's the final 2 weeks of December where the biggest move typically happen. Now, the apparent reason is the holiday-inspired buying bias. So reason number one, positive sentiment. But number 2 and 3 are lesser known: year-end portfolio restructuring, or what some people call window dressing. Everyone wants to end the year in a good way in order to keep their clients happy and make sure they get good compensations. And I'm sure we can all agree that that's how the industry works. And that does create some uplift in the market structure, but also weaker tax loss selling in the first half of December, apparently, according to some research, adds to the pattern too. Now, what I would add is that the market setup in terms of price and time is super key, and a lot of people look at seasonality without any regard to the market context in terms of price and time, and I think that is a crime, one that I'm sure none of us do, because we understand the importance of charting, but also looking at both those components. Now, there's a lot of talk about what about the presidential cycle, because it's next year, 2024. That's a whole discussion for another time. But just in brief, my analysis remains conservative on the presidential cycle. This is something I studied a long time ago because I was asked to by my boss and mentor. Clients wanted to know, and these were top institutions at the time. And the results that we came up with is that, no presidential election is the same. And for that reason, no presidential cycle is the same. The beat of the cycle might still be the same in terms of 4 years, but the nature of the cycle does skew. And the 2 components that were the biggest in terms of variation is when you have a double term presidency, otherwise known as a lame duck. No, this is the term. This is not me dubbing it. Particularly this year with President Biden's historically low votes. All that means is they have less firepower to influence markets and policy. More so if you have a gridlock Congress, which is a third factor I'd add. But the second factor, which I think is most important, is the stage of the economy and the market. Ultimately, if we're in an asymmetric situation where downside risk is highly likely, it's very difficult to deal with that. Some people believe that we can still pump our way through until the election 12 months from now. Time will tell, but our analysis some years ago remains conservative on that. Okay, quick kind of word of warning, and I say that just from one professional peer to another. In terms of mistakes I've made and lessons learned from them, there is no one size fits all. It's great when we find a pattern, price or time, but as we all know, it works some of the time, not all the time. If only there was a holy grail. I searched for it a long time ago, and was really upset that I wasn't able to find it. Then now realize markets and life is not like that. This is a chart from Goldman Sachs. Many banks are doing the same type of analysis, and you'll see it appear year after year after year. They'll backtest the historical performance of a pattern, in this case, one of the seasonality patterns, the Santa Claus Rally. And then they'll overlay it with the current market. I do this too, and maybe some of you as well. But here's the issue. In isolation, everything looks good. And so just be aware of linear thinking. Also be aware of the behavioral biases that can develop. There are many times where I've traded something like this and got burnt pretty bad because I just wasn't open-minded to a potential alternative variation. In my experience, it's always good to look at seasonality variables. This is something that I was really grateful to see shared at the FSC team, where they look at statistical evidence of seasonality impact, but they look at base case, best and worst. And my recommendation would be to do analysis like this, when we can look at minimum, max, average return, and we can not just look for the consensus trend, but look for the outliers. And then we can drill down into the outliers. So the consensus is what we trade off because that's the high probability. but the outliers are alternative scenarios that may or may not happen that we can at least be prepared for. An area that I've specialized in recent years is scenario planning. It's well known and originated from the military. I think also various business sectors have recently adopted it, but also traders naturally also think in terms of scenario variables. And I think it's a useful thing for us to do. So you can see here just how wide the deviations are, particularly at the cycle turning points. So you can have a Santa Claus rally that just totally fails. You can see the negative 6% or so. And then one that just really outperforms 2008, around 11%. It's good to go through each of these one by one and understand why that particular pattern took place.
I like the, what is that, 2000? You get wild swings and end up with nothing.
Yeah, there we go. Yeah. And that happens more often than not.
It worked. Yeah. It failed. Oh, it did nothing.
Yeah. And I was just thinking, Jake's portal is great for this because he's got the statistical evidence of how each of the seasonality works, but he also has the trade risk reward, and he has the robustness of each of the patterns, which is key. So the well-known seasonality expert of the 1960s, Jeffrey Hirsch, who's the pioneer behind the stock almanacs that still get published until today, had a different variation on this seasonality of the Santa Claus Rally. He said that yes, when Santa Claus Rally works, great, you can trade it. But he said if it doesn't, if Santa Claus should fail to call, bears may come to Broad and Wall. Broad in terms of Broad Street, think of Russell 2000. Wall in terms of the Dow Jones Wall Street Index, blue chip stocks. And the times. So I've just explained when the Santa Claus Rally works. This is when it doesn't work. It's when markets are overbought. And just to be correct and clear on this, markets can either accentuate the overboughtness, so it will just become even more overbought, or it's overbought and so therefore reverses. That's what I think is happening now. Or markets that are flat, or the most obvious one, if it's a positive seasonality influence and you're in a bear market regime, then it's naturally going to be more muted or maybe fail altogether. It'll just get squashed. And that's true of cycles. The examples, there are several, but the ones I chose are the ones that we know well. 2000 TMT, so the tech bubble of that previous decade, 2008 GFC, and then actually more recently, the 2021-2022 topping process, where we had a strong end of the year, but a very horrible follow-up thereafter. And actually the month of January was one of the worst since 2008, I think, in 2022. And that was the market where everything underperformed except for, I think, the US dollar and energy and maybe one or two other things. So open question as to what this all means now. I'm thinking, that we could be at another juncture where this doesn't work as expected. And that then takes us to my final bit on the S&P 500 setup. This is the chart I posted on Slack. It's not updated. So right now, you would have seen a big push to the upside, and then an inside day today within that kind of range bound area. So for now, it looks like this bear trend line from the 21-22 peak areas is still intact. Always good to apply price and time filters. So don't just look for a daily close, but look for a weekly close and perhaps add some percentage deviation bands just to make sure it's we don't get whipsawed and or trigger happy and then obviously have a bad experience. The analysis shows that the blow-off rally is at a key inflection point. Clearly, market became overbought. You can see that the market's overbought just because of the linear nature of the market. It really does look like a straight line, but also the number of gaps that we had along the way. We had 3 gaps, and the third one, according to classic theory, is an exhaustion gap. Doesn't mean the market's going to reverse tomorrow or next week, but it does give you a really important milestone to watch in the short term if markets continue to unwind from extreme conditions and trigger some of these levels. So the other price resistance is also the July high, so I would add that as well as an important area. So the July high for the year, as well as this long-term bear trend, as key areas that the market needs to hold underneath for there to be some kind of downside risk unwind. If not, and the market pushes up, then of course we just have to carry on with that trend extrapolation. Some of you might have some questions in terms of all of the additional overlays on my chart. Happy to speak to that at the end if we have any time during Q&A. But just a quick walkthrough. So you've got the classic technical analysis in terms of a bar chart, trend lines. This trend line is based on a dynamic regression line, also known as GAN lines. But essentially, we're just looking at the trend slope, and that's a mathematical number that you can add. And what's great about that is you can be precise, but you can also be predictive. You can be predictive because you can choose an important inflection point in the market, extrapolate it because you think it's important, and that often highlights key inflection points ahead of time. Doesn't work all the time, and obviously you're going to get different types of signals, but it's given me an edge all these years, along with the classical trend measures. The probability distribution on the left, people might think of it as market profile. It's a kind of next step evolution to market profile, but without the intricate letters which give you the behavioral sentiment detail. So this just tells you where the value points in the market are, but also where the gaps are, and you're likely going to get a fast move in the market. If you didn't use that indicator and you just looked at price, you'd still be doing great. But the indicator helps to identify things that you might miss. And often it can kind of give you just a different way of judging changes in trend. And then I can just see here a question from Peter. Thank you for asking about the symbols. So I often talk about the cycle analysis that we all do as the broad variations of timing and cycles that we can use. I use the Foundation Study of Cycles software actively, and always have questions for Lars and Richard on that, and happy to watch the sessions that are hosted. But also in addition to that, I look at market cycles in terms of different ways of measuring market cycles. I look at also natural cycles, and so the question that was asked there by Peter about natural cycles in terms of planetary cycles is something that some of the team members use, including myself. Bill Sarubi is one of the experts in that field, and I know he presented just recently. So you can see those cycles overlaid on the screen here, and also at the inflection points here and here. Last point I want to end, because we're finishing on time, is for those of you looking for a trigger, my guidance is maybe if you're really good at finding a trigger and being timely, wait for the market to reverse, if it does reverse, below the exhaustion gap for a final confirmation. Or if you want peace of mind and sleep at night, an option contract would probably be wiser, just because this market has been so precarious. And then just to end, this is the long-term trend line from 22. Sorry, there's a typo. So just so you know, the point that I've drawn it from, but also just to highlight the point that if the market does carry on being irrational far longer than we can stay sane or solvent, the top line of this uptrend from October is around 4,800, just underneath the roundophobia 5K handle. So that's worth keeping in mind in terms of an extended bullish scenario. The FSC model, according to the interpretation that I've made, remains bearish. I've included the histogram, the spectrum histogram there, just so everyone can have a visual on that read. But this is the default readout, and it shows risk into the end of this year, but also Q1. Worth using the overbought reversal, which I don't have shown here. And I'm sure Richard's shared it many times as a way of, so when the momentum indicator is overbought and then reverses as a trigger, just in case that there are any false signals. And then the last slide I have, second to last, is the market internals. You still have extreme concentration risk and market fragility. This is showing that the whole Magnificent Seven or FANG concentration risk of mega cap growth stocks is as extreme as it was in 2000. So it's been narrow breadth leadership for a long time, but actually it's at historic extremes. And if you look at the S&P 500 on an equal weighted basis, on TradingView, you just need to type in the ticker RSP, and it's an index by Invesco. And you can see we've been sideways for the year, just above the mean right here and now. It's bullish, but not as much as we may think it is. And then the final chart, and I'll stop here for time. And if we have questions, great. If not, happy to take it on Slack. This is showing the upside revision that has happened with the smartest mind in the industry. So I'm alluding to the big banks. And you could see that a revised year-end projection for the S&P 500. So this changed when we had the bear market rally or the current rally, whichever name you want to give it. And the top side is 5,200 by Deutsche Bank and BMO. Bank of America, RBC 5,000. In the middle range, Goldman Sachs and Societe Generale at 4,750, 4,800. And on the little bit of the kind of same to bear case, Morgan Stanley and Barclays. Now it's interesting just to see, the projections out there, but most importantly is the spread between all these forecasts, 700 points, which for me, this is something I've always been interested in for years from a behavioral point of view. Whenever you get these wide divergences, then more than likely there's a pain trade ahead where someone's right, someone's wrong. And there's a big shift to wait out for. That's all that I had prepared. Thank you for the invitation. I hope the insights are useful. We had a look at the market landscape, Santa Claus Rally, and S&P 500 expectations.
So do I gather that you are skeptical of the Santa Claus Rally this year?
Mindfully skeptical. So I try and have my biases in check.
And is the Santa Claus Rally you're defining somewhere from mid-December to the first week of January? Yes.
So the point out, yeah. So according to the work that I've done, and also others who that share the same perspective, yes. So that would be that's been my experience. Industry standard, they only look at the start and end of the month.
Yeah. Okay.
Which is still relevant, but I think it's worth looking at different variations. And then also in January, you've got the January barometer, other seasonality, measures that are also useful. But if you're just focusing on this in isolation, part of the part of why the bigger picture of the Santa Claus Rally and why it works is because after we get the well-known correction or crash in September and October, with September being the worst month in the year, then you get the best 6 months outperformance in the market. That's historically been back-tested. It's also been researched by academic universities. That's well known. So the Santa Claus Rally, that year-end outperformance, is part of the 6 month.
Yeah, there's lots of different definitions of Santa Claus.
Yeah, and some people call it year-end. I think most people remember it as Santa Claus in terms of the old school Wall Street almanacs.
I always think of it as the late October to or first week of January from the seasonal trader Jake's stuff, you know.
Yeah,
but
I know Jake is dubious about some of the seasonality, well-known seasonality setups. Maybe Santa Claus Rally, maybe others. Partly because he's back-tested it, he's traded it, and works with what's most reliable.
So Gail asked, where was this chart posted? I think it's in the current cycles in futures channel, Gail.
Yes.
So,
and
questions for Ron?
Open question if we should be sharing charts in other channels, just for better,
we
better
find it.
review.
All right. Any questions for Ron?
Very informative. Thank you, Ron.
Thank you, Ron.